Hi, everyone. John Delia here of Housing JV, Housing Joint Venture. Happy you could join me on today's course. We're going to talk about real estate impact investing, economic opportunities, and the market landscape. Here we go. Give me this. Is that how we do it? Okay. Me. Hello and welcome to another Housing Joint Venture course. I'm John Delia, founder or one of the co-founders of Housing JV. Happy to have you here today. We're going to talk about real estate impact investing, economics, and opportunities. So we're happy you joined us on this journey. Obviously, it begins with small steps, and this is one of the first steps you have to take, education. Now, a lot of people, want to invest in real estate like this guy, Money Mayweather, and it's for what? Money. They're very excited. They want to make money. Others, they're concerned about what's going on in Wall Street. They want to know, if the market volatility is going to really affect me and my portfolio, and do I have confidence investing in the financial markets? People are concerned with what's going on in politics in America today. There's a lot of political instability, I guess, with the president currently. There's a lot of hype in the media. So I think from an investor standpoint, once again, that political instability affects, the financial markets and ultimately our portfolios in the end. Some people, want to invest in real estate for a legacy. So they want to be like this queen bee over here with her beehive and all her fans and her followers, etc. You want to build that legacy and you want to be remembered for generations. So whatever the factor is, we're hoping to answer some of your questions today. Feel free to take notes with a pen and paper and, continue the conversation in the forums. So by the end of this webinar, we're hoping you're going to learn how real estate can secure your long-term income, and it helps you diversify your portfolio, and, it has tax advantages. You're going to learn how to maximize return while leaving a legacy through social impact investing, or real estate impact investing, as we call it. And finally, you're going to discover where attractive real estate deals are that are low cost to entry. So once again, I'm your host, John Delia. And these are just some of the photos, through my career. This first one on the left is actually me with my first investing partners. I started an investing company with these guys, 2 architects, 1 attorney, and 1, small business investor. The next one is just me speaking on panels. I frequently speak at universities, panels. I've written a book. I've been on television. I've had a TV show, etc. So it's really a privilege to get to share my experience and education in real estate. A lot of times you'll still find me in the field. I don't talk about it as much, but I definitely am in these houses, renovating them, painting them, and doing demo. And finally, we try to give back as much as we can in the community by doing murals, gardens, and other kind of social projects to help, ultimately kids who are impacted and affected in these communities. So let's talk about our agenda today. The first section, we're going to discuss real estate as an asset class. Then we're going to talk about the new opportunities in real estate investing. We're going to talk about where and how you can get involved. And finally, we're going to talk about housing joint venture if you don't already know. So now let's talk about some definitions. We always want to make sure that we're on the same playing field. For more definitions, you can look on our website, Housing Joint Venture or housingjv.com, in the resources and glossary section. So what is an investment? An investment is a commitment of money, effort, and time with a certain risk in exchange for financial gain. Income investors. So income investors expect to hold a property for a number of years. We're buying it for the year-over-year income with long-term building of wealth, aka growth in value, aka equity. An asset class. An asset class is a group of securities that exhibit similar characteristics, it behaves similarly in a marketplace, and it's subject to the same laws and regulations. So let's dive deeper into an asset class. You can have stocks, you can have bonds and CDs, you can have real estate, you can have commodities, and you can have cash. So, billionaire John Paulson, he's a famous equities investor. He says if you don't own a home, buy one. If you own a home, buy another. And if you own two homes, buy a third. And John really was famous in the market collapse of 2008, 2009, where he bet against the financial markets, saying that the real estate market would crash, and he made a lot of money doing so. So what all these people have in common? And if you'll look, there's an empty spot here, and it's hopefully going to be you. And you'll join me at the top left corner. But no, seriously, these people are billionaires in real estate. You'll see our president, Donald Trump, is also centerfold. And these are self-made real estate billionaires, meaning, they made their wealth owning, buying, and developing property. And, when you think of these people, you think about the luxury, you think about the lifestyle, you think about jet setting, and the financial opportunity it gives you for investing and for living a really great life. But we want to talk more about the social impact and the community impact and ultimately the people impacted by your investments and by your choices, because you're going to have impact on a lot of people, how you allocate your capital. So really, real estate affects how we live, it affects how we work, it affects how we play. So it affects many facets of our lives. So now let's jump right into section 1. So really, there's 4 ways you make money in real estate. The first way you make money in real estate is known as cash flow. And that's, as an income investor, the year-over-year profit or the month-over-month, rent that you're going to be collecting. Next, you make it through growth in value. And growth in value is also known as appreciation, meaning the year-over-year gain or loss in value, but hopefully the gain, so it's a growth, that you're going to see with property values. Then when you leverage real estate with mortgages, you can look at the loan amortization as a way you make money, because basically you're locking in a rate, an interest rate, a fixed cost of money or capital for the term of usually 15 or 30 years. So that loan amortization is going to allow you to buy money at a cheaper rate, because inflation is also going to affect the growth in your money. Next, let's talk about tax shelters. Real estate is a great tax shelter because of the benefits it's going to offer you through the flow-through income or tax advantages through depreciation or certain write-offs. So it's a great tax shelter and one of the best known tax shelters out there. So now let's look at the historic performance of real estate, and we're looking at returns on this chart. Really, it's historically surpassed the market, and REITs are just another word for real estate investment trust. So let's talk about how real estate is different from all the other asset classes. And first and foremost, real estate is tangible. It's a physical asset. It meets a basic human need, meaning the demand will always exist and it's never going to go away. It's exceptional returns for smart investors, meaning that through deal making and value-added opportunities, you can create more value in a real estate deal that's dynamic. And finally, there's a proven value proposition because of the income, because of the appreciation, and once again, because of the tax advantages we previously discussed. So now let's talk about real estate as a diversification and how it's different, once again, through these other financial instruments or asset classes, and it provides appreciation and dividends. So first, we'll look at stocks and mutual funds. And when we look from an appreciation standpoint, there's a rise in principal with the market growing. And when you look from a dividend standpoint, you're going to get a yield, which is just a payment of cash or income. The pros are that it's low maintenance and it rises typically with the economy. And the cons are that with corporate profits often shrinking, it affects the dividend payout, and there's an exposure to volatility. And that's just the rises and falls of the stock market. Next, we'll talk about bonds. And a lot of people don't actually know what a bond is. And a bond is nothing more than debt. You can buy a corporate bond, you can buy a muni bond or a public bond. And this is just, an entity selling you debt and offering to pay you back at a later price with a fixed rate of return. They provide no appreciation, meaning they don't grow in value. They're just giving you a fixed locked in interest rate. And that dividend is paid through interest, So the pros and cons, let's talk about that with bonds. They're low risk, meaning they're fixed, there's a predictable rate of return, and they vary in terms of the risk level. But it's also secured assets. So it's secured on the company balance sheet and they owe you that money. Now, the cons in bonds are that they're low growth or no growth. So they're going to be fixed at that rate of return. Next, you have direct real estate investing, meaning you yourself can buy a house, you can fix it up, and you can do things to it. So with direct real estate investing, you're going to see home prices grow typically. So, there's appreciation. Next, dividend is paid through that monthly rent. So that's where that income is going to come from. Some of the pros are that it provides a stable income. And some of the cons that are well known are toilets, tenants, evictions, and trash, meaning the management or the manual effort that you're going to have to create value with. So there's expenses that come with it. And typically smaller investors don't have scale. Now we'll talk about real estate impact investing, and that's what we offer at Housing Joint Venture. And really the appreciation point is that property values increase. So you're going to see a growth in value. Next, the dividend comes from profit sharing through the monthly income, or otherwise known as the NOI, the net operating income. Some of the pros are that it provides that stable income and there's minimal involvement, meaning you can really pick your asset, do your diligence, and really set it and forget it. And some of the cons include the opportunity costs of capital. And what we mean by that is you could invest your money in other asset classes. So you have to do a cost benefit analysis. And really you just have to weigh the pros and cons of whether you should put your money in a real estate impact investing fund, or should you put it in one of these other financial instruments that we've discussed above. Now let's talk about section 2, which are the new opportunities for real estate investing. So in 2016, the real estate housing market was nearly $30 trillion in record value. The commercial housing sector, or the commercial real estate sector, provided another 10 trillion in value. So, there's a lot of money in real estate. The national housing market gained 1.6 trillion over the past year, and that's a 5.7% increase from 2015 levels. So you're seeing steady increase in value in the real estate markets historically. Renters paid nearly $500 billion in 2016, or you could look at it as a 3.8% increase from 2015. So people are paying a lot of money in rent. Once again, it meets that basic need. So now let's talk about a sociologist named Matt Desmond. He recently wrote a book called Evicted. He says that I don't think you can address poverty unless you address the lack of affordable housing in cities. And let's talk more about that. Let's dive deeper. So when we say affordable housing, what does that really mean? And housing generally is considered affordable if a low-income renter is paying no more than 30% of their income on housing. And that's with utilities, mortgage, taxes, insurance, etc. What does it mean to be cost burden? So a household is cost burden if they pay more than 30% of their income to housing. What is severely cost burden? That means you're paying more than 50% of your income to housing. So now let's talk about the state of renting today. One, housing that lack affordable housing. So let's talk about households, that lack affordable housing. And really, when you're at the extremely low income rate today in America, there's only 35 houses available to you in terms of affordable housing. When you're at 50% of the average median income or the area median income, there's about 55 houses available to you for housing. When you're at 80%, you got 93 options. And when you're at 100%, you have 100 options plus. So really, the more money you make, the more available housing stock there is for you. The less money you make, the less available housing stock there is for you. Overall, the entire country currently is affected by affordable housing crisis, meaning that less than 30% of low-income earners have access to affordable housing. There's an extreme shortage in the Midwest, and areas that are severely affected are typically coastal cities where the competition for jobs, housing are much more fierce. Really, across the board, when you look at major cities, rental units have not kept up for the demand, meaning that there's more renters out there than there is a supply for affordable housing across the board. And another word we can describe this is budget-friendly housing. So in major cities, you're finding a lack of budget-friendly housing, even in the higher earner category, meaning that once again, the rental population, there's more renters than there are housing. And currently, you're seeing rent prices outpace inflation. So on average, you're going to see the cost of living index increase about 3.5% year over year. And that's just the cost of goods and living going up. But you're seeing rent outpace that. So, once again, renters are going to continue to pay more for their housing needs across the board, and there's a shortage. So when you look at this chart, this is just showing or visualizing that inflation, meaning that in 1990, your income bought you more in terms of housing. And when we look at 2016, you're going to pay more on that same income for housing. So how do we end up here? And, I'm just going to highlight two of the major points. The first major point is the discriminatory lending practices that occurred in the late 60s, 70s, and 80s. You have to realize that, Martin Luther King and the, Fair and Freedom House, the Freedom Act and the Chicago uprisings, etc., that all was to provide equal access for minorities to get housing and the same quality as their peers or counter peers were, these Anglo-speaking, Europeans. So, with discriminatory housing practices, this was institutionalized, meaning that the realtors, meaning that the bankers, meaning that the people who participated in transacting in real estate all came together, meaning the government also in terms of lending for housing vouchers initially. There was a lot of discriminatory practices that created redlining and just, negative impacts on this housing market. And finally, we'll talk about the other effect, and that's the rising construction costs. Currently, there's a shortage in labor when it comes to construction. So in America, we don't have enough skilled workers to do the jobs we need to build the housing we need. And also influencing the rising construction costs are, when you look at the commodity prices and the pricing of oil and petroleum, really, oil creates a lot of derivatives that can create building materials. And as the cost for building materials continues to increase, you're going to find the rising construction costs increasing also. And the final cost that's rising is the pricing of land. Land values of cities are becoming more competitive, and you're seeing once again an increase. So all these factors adding on, including the need to make money and have successful projects in the long term, lead to increase in price. But here, my friends, lies the opportunity. So I don't want to seem all doom and gloom. There is hope at the end of this tunnel. The first part of hope is to repair and renovate housing. So renovate, restore, and repair housing stock. There's an abundance of housing stock in America today that is somewhat functionally and physically obsolete. And there's a huge opportunity to renovate, restore, and repair that housing stock. Now, new apartment demand is outpacing annual construction forecasts, meaning that even until 2030, we're not going to keep up with the demand. So this is a simple supply and demand issue where we don't have enough supply to meet the demand. So where and how can we get involved? So once again, we just want to set the stage and continue to provide you a lot of history and value. So historically, real estate investing has been an exclusive club. You've come from a rich private network, so the assets trade amongst themselves between the peers in this network. Big banks or institutions have large holdings in real estate, so they control a huge sector of the market. Family-owned dynasties or inherited properties create a huge holding of landlords. And finally, you have smaller mom and pops who have limited scale and limited impact currently in the market today. There's a bulk of mom and pops are formed up by these inherited population. Next, you have people who bought a house and they decided to rent out their first house and not sell and just move into a new household. And finally, you have that landlord who owns 2 to 4 rentals, but is still pretty small and doesn't meet the qualifications to be an institutional investor. So let's talk about what's holding these investors back right now. And really, we believe 3 factors are holding them back. One, the lack of strategy and planning. So, when they started off, they didn't really plan to get or become big. It was really an afterthought. Next, the lack of infrastructure and processes. To get big, you have to have processes and you have to run a business efficiently to have good margins and to sustain profit in the long run. And finally, access to capital. Real estate gets very expensive, and needing to get more mortgages or commercial mortgages limits a lot of investors from a financial capacity standpoint. And once you get past banks, secondary markets of capital become more competitive, and you have to be qualified to receive that capital. So here, once again, lies more opportunity, and that comes in the form of a new business model. That business model is known as crowdfunding. So, here's a great illustration to talk about crowdfunding. Really, real estate developers have projects that they need financing for. Investors want to participate in projects because they have money and they want to receive a financial gain as well as, once again, participate. So, the crowdfunding, such as Housing JV, acts as a portal or an intermediary in the middle who provides or facilitates a platform so that investors and developers can meet each other and participate in these types of transactions. So let's talk about more about what is crowdfunding. And really, the SEC has the Investment Act, which limits who can and can't participate in investment opportunities. And really, you had the Jumpstart Opportunities for Businesses and Startups Act that came in the Obama era of our economy. And what that did was that offered new regulation, meaning the IRS and not even the IRS, the SEC, the Securities and Exchange Commission, changed its regulation for the first time in about 83 years in terms of how the Investment Act operates and who and when can participate. And what it did was it created new classifications and old classifications it modified, which talk about Regulation A, Regulation D, and Regulation CF, which is known as crowdfunding. So these regulations, once again, change who can participate in these deals from an accredited and non-accredited investor standpoint. And once again, you can learn more of these terms in the glossary on housingjv.com under resources. And from an accredited investor standpoint, you typically would have to make over $200,000 as an individual or $300,000 as a household income from a marriage standpoint, or otherwise have $1 million in assets to invest in certain types of transactions. And with these new regulations, it's changed and it's allowed more everyday people to participate in the transaction. So this transaction is no different than a marriage, meaning that, typically the hold periods and how long you're going to participate in the deal lasts longer. So you're going to have to understand who you're getting in bed with and who that other partner is on the other side. So what we'll do now is we'll talk about passive income investing from a debt and equity perspective. Debt means debt, meaning that you're going to lend someone money, you're going to get a rate of return on that money at a fixed rate similar to a bond. And equity means it's more ownership and there's more long-term benefits, but it also comes with more risks. So let's talk about the differences. First, when you look at debt from an investment amount standpoint, there's a fixed amount you'll invest, meaning that if you invest $10,000, that's the only amount you'll have to invest. You won't have to invest more. But with equity, there are varying investment amounts. So the project may need more money, so that $10,000 might turn into $50,000. If you've watched the show HGTV or, Home Flippers, one of these shows, Chip and Joanna, you will see that, the contractor comes back and say, hey, there's this unexpected project or unexpected cost. We're going to need more money. So with debt and equity, you're going to pay and participate at different rates in the deal. Next, let's talk about the rate of return. And once again, with debt, you're going to get a fixed rate of return. With equity, it's going to depend on the investment strategy or the exit strategy. When it comes to exit opportunity, debt, there's going to be a fixed maturity date. In equity, you're going to have a predetermined strategy or sell-off, which can vary. Now, the timing of a debt deal is a fixed timeline. And once again, equity is somewhat flexible, so it's subject to market conditions. And from a tax implication standpoint, there are incentives for debt, but you have to be using a tax-advantaged account, such as a self-directed IRA. And from an equity standpoint, you get direct tax deductions. Now, the capital burdens of, debt, there are none, but from an equity standpoint, there may be additional capital contributions or personal guarantees when it comes to financing or long-term finance. So now, how do we make sure that the partner is suitable to deliver returns? And if we're talking about social impact, how do we ensure that is kept in mind? So you have to look at three major buckets. The first one is the investment philosophy. The next one is the investment style. And the final one is the investment timeline. Now, to dive deeper into that, the investment philosophy is really talking about that track record. The investment style is talking about the offering style, meaning is it debt or is it equity? And finally, the investment timeline is talking more about exit strategies and what's going to happen when we're looking to exit or refinance this asset. Finally, you want to make sure that you're receiving proper auditing and details in terms of the quality of the product as well as the finished product. Meaning that if it's renovated, you'd love to see before and after photos or visit the project. And once it's producing returns, you'd like to be able to see the books and, get access to information. So with this new business model, this isn't really that new, and there are very successful companies doing it. Each of these are, competitors in the space who provide similar aspects with different investment philosophies. Now, we're saying that the average crowdfunding sites and some of those sites we just showed you are really missing the boat on the real impact because they're only focusing on Class A real estate. They're not really focused on this market for repair, restore, remodel when we're talking about B and C product. So that's where Housing JV comes in, and that's really where we're offering this new investment opportunity and this new business model. So let's dive deeper into what is real estate impact investing. And really, real estate impact investing is when we're delivering a dual return, otherwise known as a financial and a social return, meaning that as much as we want to see an increase in our return on investment financially, we also want to impact the lives of people, the community, and ultimately the environment when we're investing our dollars. So we're going to impact families and we're going to impact a triple bottom line, not just our own bank account. So, really, we offer you the opportunity to partner with us from Housing JV standpoint. You can either bring your own deals that you'd like us to help you develop when it comes to impact investing, or you can participate in our own curated deals when it comes to impact investing. So really, we view ourselves as removing the barriers to real estate investing. As you know, we offer this education as well as we offer the curated experience for investing. So, to do this investing with us, we have to sustain as a business. Really, we offer 3 different levels of service. The first one is a basic, education only. Well, you'll only receive our e-courses, recorded webinars, and community networking access. The Pro offers you access to education and investing, meaning you can invest in our pre-selected curated opportunities. And finally, if you pay our annual fee, you'll get access to our preferred providers. You'll get access to, bringing us deals to joint venture, as well as other benefits. So feel free to take time on our website to review these opportunities and figure out which one meets your needs and is most suitable for your situation. Here's a more recent partner experience. They were very excited to join partnership with Housing JV. It's more than exceeded expectations. They've been provided with tools, resources, and support, and they look forward to expanding and growing with us. So we're really excited to have our partners, and we're really excited to have you here with us. So if you're ready to join us, just feel free to jump on our website, select the membership that is best for you, browse the investment opportunities, and make sure you're gaining more education as you move forward in your investing. So thank you for listening. We really look forward to having you. Thanks for being on this course, and we'll catch you next time.